Folks, what if interest rates are not going down anymore? Lance Lambert, the amazing creator of Resi Club, put out an interesting post the other day saying that the majority of our interest rate reductions is now behind us as opposed to in front of us. And of course, we have Jerome Powell yesterday in front of the microphone, once again kicking the real estate industry in the nuts, theoretically, and took mortgage rates again higher. We now have 5 times, the last 5 times the Fed cut, mortgage rates went up by the end of the day. And that is, one used to say that's not historically accurate, but 5 times in a row, 5 for 5, I think we have a new trend. So, Jonathan, we need to talk about what does it mean if the interest rate kind of reductions are behind us? Maybe we stay where we are for the foreseeable future. And I'm talking years. We're going to be at between 6 and 6.25, perhaps for a couple of years. What do you think?
Yeah, I mean, listen, I think as long as inflation continues to be a threat, then interest rates, whatever the Fed does, I mean, listen, the Fed may be about to get politicized, and the Fed funds rate may go down. But frankly, I think if that happens, it'll make interest rates go even higher.
Yeah, the bond vigilantes will take the long end up.
Yeah. So I don't think that there really is any interest rate relief short of like actually dealing with the budget deficit, which, current administration seems hell-bent on making it worse. And so I don't think that that's going to happen. So I think that interest rates, I agree with Lance that interest rates are kind of where they're going to be, absent, a big economic calamity, which is going to have other problems for real estate, right? Yeah. So that means, I think, really one of two things. I think either real estate prices are going to have to adjust downward, or real estate prices are going to just be flat for a really long time, and they will adjust downward in real terms, not in nominal terms, right?
Yeah.
But that's really the only alternative, because the numbers just don't work, for commercial real estate, right? If you're running numbers at these interest rates, they just don't work. And the only way to go is down. And listen, we had an incredible bubble in commercial real estate, right? Yeah. It's a wonder that the bursting of that bubble has not created greater economic problems, and it still may, because I think there's a lot of shadow zombie deals on banks' balance sheets, and none of that stuff has been dealt with yet. And I think it's going to be scary once it is dealt with. But that issue aside, we had this incredible run up of real estate, and there really isn't anywhere for it to go but down. That's just what happens. And people got greedy on,
well, they got stupid. They just got stupid.
They got stupid and greedy on an historically unprecedented combination of factors that led the price of real estate to go boom, and really withdraw any of those factors and it goes bust. And we withdrew 3 or 4 of the factors that were driving it. And this is just going to be the hard readjustment that you get after you have a financial euphoria, right? And it's just the nature of it. And interest rates are not going to save it. Nothing is going to save it, because it was driven by so many different factors, including investor overconfidence. And you got to bring all those things back to get the bubble back. And it's just not going to happen. People just need to get realistic about that.
Yeah. And this is why it's important to have this conversation, because again, I'll play the residential side, but obviously have interest in commercial. And I've been salivating over commercial opportunities. So when I think residential, I think my call from a couple of years ago that we're going to have 5 or 6 years of basically flat is looking more and more likely. I mean, shoot, we're halfway through that at this point.
Yeah.
Because again, unlike commercial, which I'll go next, you don't have that debt problem, right? The debt doesn't reset. It doesn't force a decision.
Yep.
And that way in the residential space, you just bounce along the bottom of 4 million transactions, right? Because again, there's always going to be transactions, but it won't be 6.5 or 7 million. It'll be 4 million. So the market's going to be constrained for years to come. But let's go back to commercial, because I think this is where the pain is. And frankly, I was trying to think the other day about what could cause the Fed to really turn on the money printer. Because one thing we learned yesterday is not only did we get a rate cut, but we also learned when QT, or quantitative tightening, will stop, when they will stop rolling off their balance sheet. And that'll be December 1st. And according to Bank of America and Goldman, that's going to act like or feel like another quarter point cut. But when I step back from that and I go, okay, what about commercial? And it just feels to me, I don't know how there can't be hundreds of billions of dollars of bad deals just lurking out there that have to be dealt with. Right. And eventually that's going to come to be. And again, having invested through the last popping bubble, it could just all show up at one time. That's why the residential space exploded, because all this debt reset across the country and it all showed up. And then, it just, the cascading started. So, I don't know that they can just keep dribbling out deals, onesie twosies. It just doesn't seem like that ends well.
Yeah. And listen, I'm already seeing, just from people that I talk to, stuff that I'm involved with, that extend and pretend is wrapping up. And
good.
And because the lenders want their money back. Right. And they're like, and those folks are like, we know there's like, the bubble is not getting reinflated. We just have to take our lumps and move on.
Yeah, and that's why I think this Fed thing, and if Lance is right, I think that could be a forcing function, because whether we like it or not, there was a lot of hope that rates would fall and this, that, and the other, and it would bail out a couple of deals. It's not coming. If rates stay where they are, it's not coming at all.
Yeah. And like I said, and I still didn't actually answer your question yet, but like I said, like the just interest rate relief alone is not going to help.
No.
It's not going to help like markets where you have, rent declines, markets where you have, higher than stabilized vacancy, right? Like all this stuff has to work its way through the system before you start getting rent growth again. And then, then interest rate relief could also help it. Like there's still the, expenses are way up over where they were. Like there's just so many different things that are at play here. But to go back to what you were saying a minute ago, because I knew that's where you want to take this, the commercial market is just very different. You don't have 30-year debt, right? So you have 5, 7, or 10-year debt typically, and 5 is the most common. And banks will not give you more than 5. So if you can get agency debt, you can get into 7 or 10-year debt, or CMBS debt, 7 or 10-year debt. Deals with 7 or 10-year debt, 7 years, getting up to the point where 7 years may not really help. 10 years, they should probably be okay over 10 years, but I'm sure there are deals even with 10-year debt that, will still be below, below their purchase price.
Sure.
Maybe they're going to not lose all their equity, but I mean, they're going to be below their purchase price still, I think. But anyway, the thing is that you have to refinance after 10 years, right? And when interest rates go up, it does two things. It reduces the value of the property, right? It also increases your debt service. And when banks are only, banks will lend only 70% of value on a refinance, and you have to meet what's called the debt service coverage ratio. So in commercial real estate, the banks are not happy with you just paying your debt. You can actually get foreclosed on if you're not paying, if you don't have enough cushion over your debt, right? And so they will only lend at, if you have at least 1.25x debt coverage, which means that your net operating income, so that's your income after all your expenses are deducted, but before your debt service, that must be 1.25x, right? So if let's just say you have $100,000 of debt service annually, you have to have net operating income of $125,000 or you don't get the loan, right? Now, if your interest rate goes up, right, and your NOI stays the same, well, maybe you did have 1.25x on your old debt, but now since your debt service has gone up, right? Maybe now your debt service, instead of costing you $100,000, cost you $110,000 because of interest rates. You have not met that DSCR. So the bank is going to lend you less money, which means you don't have enough money to pay off your existing mortgage, which then means either you're going to turn around and put more money into the deal to do a cash in refi, or you're going to sell, or you're going to get foreclosed on. And this is just the math. So
just math. Yep.
What we've seen over the last few years is people going to their lenders and saying, please, 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 please extend my loan. Sometimes they had a couple of years of extension built into their loans already. It was a 3-year loan. They had 2 more years of extension. All that is running out right now.
Yep.
And in addition to which, a lot of people bought these rate caps, which, last year they went to their investors and they raised money to buy another rate cap because they thought we just got to get through to the rate, till rates go down. Now rates are not going down. So now the question is, are we going to go and put more money into this with the realistic possibility that next year when our debt is really due, we can't refinance, and we've basically just thrown another couple $100,000 down the drain, right? So, so I think that the math is just going to catch up, and so all these people have been saying the bottom is already in, transactions are starting to rise. I mean, but the problem is that there's just this enormous, shadow inventory of and this is like a term. Remember, we heard this term all the time
about this before. I think people are
the great financial crisis. Remember the shadow inventory of houses that had not been foreclosed on. Well, this is coming to a commercial deal near you, right? Where
it is
where there's this shadow inventory. And the funny thing is, you've seen it in the office space. I mean, man, that just took a whack, but it happened really fast, right? There wasn't any of this let's hang on, let's extend, let's hope it gets better. I mean, everybody just looked at that and they're like, man, this is effed,
ugly,
and it's
get out.
We're just going to foreclose and we're going to sell these things for 5% of their, the previous sale price. But that just has created liquidity in the market, and now you've got the office sector coming back. It had to reset, but it's coming back now. Multifamily, that reset has been stymied by all this extend and pretend that people were hoping, but that's going to end. And when you said a moment ago that it's all going to happen at once, that's, everybody's trying to avoid it all happening at once, but it's just going to all happen at once later on, because they're all going to run out of patience at the same time, or those extensions all run at a time at the same time, and all the stuff is coming to market, and you're starting to see the dribs and drabs of it already. I mean, I'm starting to see, the seller, the lender owned deals coming to market, right?
Yeah,
starting to see that now. So
it's really funny. We've talked about this for years because we both knew this was coming. I think it's fair to say that it took longer than I expected, right? I think it's going to end up taking a year to 18 months longer than I expected, but I think they were always concerned about it all happening at once, and they just kept delaying, and now it's going to all happen at once. And I do think this idea that rates are stable is going to be the pen that pops this bubble, and they're just going to go, I give up. And again, having lived through this before, the first movers are the ones that recoup the most, and then it just deteriorates quickly from there.
Yeah, because I think what you're going to see happen too is that there won't be enough qualified buyers for the assets when they start coming to market, right? And the good ones will get snapped up. The deep-pocketed investors who've been sitting on cash are going to buy the choice assets. And then what's going to happen is everything else is just going to come to market, and nobody's going to want it. And the people who want it, the banks are going to take a look at them and be like, you're not qualified.
We're not again.
We're not lending on this stuff. And so I think at some point what's going to happen is that some people are going to get some amazing bargains on.
Yes, I agree.
On property, frankly, it's going to be in pretty bad shape. But if you
they'll be rough. I've been here before. I know exactly what's coming. They'll be ugly. They'll be an 18-month heavy lift, multiple turnovers, but they'll also be extremely. Somebody's going to become really rich buying this junk.
And here's the thing: they're going to be available at prices where even with a massive like overhaul, your all-in cost is going to be so low
Yeah.
that the risk is actually really low. And like that's how people have to look at these things, because it's like, you look at like a major renovation project that's really risky. Well, yeah, there's definitely execution risk, but if you look at it like, okay, I know that stabilized property is selling for $100,000 a door. I'm going to be able to be all in on this, fully renovated at like $60,000 a door.
Exactly.
Like
that's coming.
There's no risk there. I mean, not no risk, right? But like you got to be able to execute it. But that's margin of safety, right? Like that's where you want to be. And
agreed.
So that stuff is coming, but it's like a slow motion train wreck. I mean, it's
going to go until it goes. And I think it's going to be 2026. Like if we think about 2025, let's just say, for example, in the multifamily space, we transacted on a scale of 1 to 10, a 2. I think 2026 is going to be more like a 6, right? So it's going to feel like a triple.
I mean, I don't know, because if you look at the GFC, I mean, you just said a moment ago, we all thought this was going to happen like last year.
We did.
But looking historically, I mean, I'm gonna not say I had a crystal ball. I mean, I thought things were going to start loosening up sooner, but the historical perspective is important, because if you look at the GFC, the multifamily market didn't actually bottom until 2013. So it was 5 years after the crash. And that makes sense when you think about like the typical 5-year debt term, right? Yeah. So people were able to kind of hold on and hope that the market was going to come back and that they were going to be back in the money again. But if their debt was not long dated enough, then they just were in a forced sale situation, and they had to get realistic. The prices came down to where they had to come down to clear, and like that's just the way it works.
Yeah. So again, folks, I think there's lots of opportunity coming. I think if Lance Lambert's right, and we've got most of the interest rate drop behind us, that's going to be a forcing function for anybody who has debt that's resetting. That's obviously very common in commercial. Residential, it likely means more of the same, right? Kind of bouncing around the bottom of transactions. I do think we've hit the bottom in transactions. We may go up to 4.2, which may feel okay. It's up 5%. But again, it's not going to be the rocket ship, no V-shaped recovery coming here. And rates may be, all of 2026, rates may be rough and tough 6%. So just write great deals at 6%. Don't hope we're going to 5.
Yeah. And I saw people too, like I was talking to somebody the other day about, like, when you're underwriting a deal commercially, like if you're underwriting cap rate compression, you're
an idiot.
You're an idiot. And there are people out there who are doing it in order to try to make deals work. But listen, we're not in a cap rate compression underwriting situation, because we haven't bottomed out yet.
Don't do that.
And so I mean, you shouldn't really ever do it anyway. But I know that there are people who are sophisticated who are like looking at where they are in the market cycle and like, look, cap rates are higher than average, so I can underwrite the cap rate compression. But we're not there. And especially for the stuff that's trading, it's still trading at low cap rates. A lot of stuff is trading at negative leverage. And just
all right. Well, this is always fun. Again, pay attention, folks. We talk each and every week, residential, commercial. Lots of opportunity out there is coming. Do the work, network, all of that good stuff. Jonathan, where can they find you?
Yeah, well, come join me on LinkedIn, but also my school group, school.com/AIC is about to drop a free level. So
the levels are coming.
The levels are coming. So if you would like to just come and be part of the community, you should just bookmark it, and that free level should drop in probably next week or so.
Awesome. Thank you, Jonathan. Have a great day.
You too.